Welcome to StokTok's deep dive into Cummins Inc. Cummins is a global power solutions manufacturer, designing and producing diesel and natural gas engines, power generation systems, and electrified powertrains for industrial, commercial, and automotive markets. As of May 1st, the stock is trading at $657. The 52-week range runs from $290 at the low end to $675 at the high end, placing current price near the upper end of that annual trading band. The stock is trading above its 50-day moving average of $583 and well above its 200-day moving average of $492, signaling an uptrend structure. The Relative Strength Index, a momentum oscillator, is reading 64.5, which sits in neutral territory. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Cummins manufactures power generation, propulsion, and component technologies across diesel engines, natural gas engines, and increasingly, electric and hydrogen fuel cell systems. The company operates through multiple business segments serving end markets including trucks, buses, stationary power, construction equipment, and industrial applications. The competitive moat centers on engineering expertise, scale in manufacturing, and an established distribution and service network across global markets. The StokTok score stands at 44 out of 100, signaling caution. Across 5 dimensions, valuation scores 3 out of 20, indicating premium pricing. Financial health scores 14 out of 20, suggesting adequate but not fortress-like strength. Profitability scores 8 out of 20, revealing margin compression. Growth scores 11 out of 20, pointing to modest expansion. Smart money scores 8 out of 20, reflecting tepid institutional appetite. Now, valuation. The question every investor has to answer: are you paying the right price? Cummins trades at a price-to-earnings multiple, or PE, of 32.04 times trailing 12-month earnings. That's well above the industrial sector median of roughly 16 to 18 times. The forward PE, based on analyst consensus estimates for the next 12 months, is 25.1 times, still elevated relative to peers such as Caterpillar or Deere, which typically trade in the high teens to low 20s. The PEG ratio, which divides the PE multiple by expected earnings growth, is 2.06. A PEG above 1.5 generally suggests valuation may be stretched relative to growth prospects. The enterprise value to EBITDA multiple, that is, the company's total market value minus cash, divided by earnings before interest, taxes, depreciation, and amortization, stands at 18.17 times. Again, above peer norms. Our DCF model, or discounted cash flow analysis, suggests the stock is trading at a 149% premium to intrinsic value, a significant overvaluation signal in our view. Market sentiment around Cummins leans bullish, with Cummins India hitting 52-week highs and rallying up to 32% in a month, while broader confidence in infrastructure sectors remains constructive. Wall Street analysts have a consensus mean price target of $643, though the range spans from a low of $490 to a high of $784, a wide spread reflecting genuine disagreement on fair value. Most recently, in Q1 2025, the company reported earnings per share of $5.96, beating the consensus estimate of $4.85 by roughly 23%. Revenue came in at $8.54 billion, but this represents growth of just 2.6% year-over-year, a deceleration signal. Operating income was $780 million, and net income was $590 million. The earnings beat was driven largely by strong execution in the company's power solutions and components segments, though revenue growth lagged expectations, suggesting demand is moderating. The data points to a company trading at a premium valuation multiple while facing headwinds on the top-line growth. In our view, the setup warrants caution on valuation grounds. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist used by credit analysts to assess balance sheet quality. Cummins scores 6 out of 9, which is respectable but not exceptional. It suggests adequate financial health but some areas of concern. The Altman Z score, a bankruptcy risk model, comes in at 5.30. A score above 3.0 generally indicates low bankruptcy risk, so Cummins sits in the safe zone, though not by a wide margin. The company's cash-to-debt ratio is 0.45, meaning for every dollar of debt, the company holds 45 cents of cash. This is workable but not fortress-like. Ideally, industrial manufacturers aim for ratios closer to 0.6 to 0.80. Interest coverage, the ratio of operating income to interest expense, is 11.77 times. This means the company generates nearly $12 of operating earnings for every dollar of interest owed, a healthy metric that signals minimal risk of missing debt payments. The current ratio, measuring liquid assets to near-term liabilities, is 1.76. A ratio above 1.50 is generally viewed as sound. Debt to equity stands at 0.66, which is moderate. In sum, the balance sheet is sound with no immediate solvency concerns, but leverage is non-trivial and cash generation will need to remain strong to service the debt load. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or ROIC, measures how effectively management deploys shareholder capital to generate profits. Cummins' ROIC sits at 12.08%. That's a respectable mid-single-digit premium to the weighted average cost of capital for industrial manufacturers, suggesting value creation, but not at the level of exceptional businesses. The gross margin, revenue minus cost of goods sold divided by revenue, is 25.29%. This reflects the manufacturing intensity of engines and powertrains. There's significant direct material and labor cost embedded in each unit sold. Operating margin, which measures earnings from core business operations before interest and taxes, stands at 11.50%. This compression relative to gross margin reflects substantial selling, general, and administrative expense, a sign that supporting a global distribution and service network is costly. Net margin, the bottom line profit after all expenses and taxes, is 8.44%. This 1,300 basis point drop from gross to net margin underscores the fixed cost burden. Free cash flow margin, or the cash available to shareholders after capital expenditures, is 7.09%. In the Q1 2025 quarter, operating margin was constrained as revenue growth decelerated to 2.6% year-over-year. In our view, the profitability picture shows a business with adequate returns, but margins are under pressure, likely due to a combination of competitive pricing, product mix shift toward lower-margin electrified powertrains, and fixed cost deleveraging on softer demand. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, revenue has grown at 6.20% annually. Over the past 5 years, growth has accelerated to 13.40%, indicating that near-term deceleration follows a period of stronger expansion, likely driven by pandemic recovery and pent-up demand that is now normalizing. Book value per share, which represents shareholder equity on a per-share basis, has grown at 12.10% over 3 years, outpacing revenue growth, a positive signal that profitability and return on equity are expanding the equity base. However, the most recent quarter revealed revenue growth of just 2.60% year-over-year, suggesting the 5-year growth trajectory is moderating materially. The dividend yield is 1.17%, which is modest but reflects a company that is prioritizing debt reduction and reinvestment over aggressive shareholder distributions. The setup is this. Cummins has demonstrated solid historical growth, but the data now signals deceleration. Q1 2025 growth fell to the low single digits. This warrants vigilance on whether the slowdown is temporary cyclical weakness or a structural shift, as electrification pressures traditional internal combustion engine demand. Now let's talk smart money. What institutional capital is actually doing with this name? According to 13F filings, 12 top-tier gurus currently hold Cummins stock. However, the recent positioning is mixed. Christopher Bloomstrand's Semper Augustus Fund holds Cummins as 2.33% of portfolio, but has reduced the position by 0.41%, a signal of cautious trimming rather than conviction. First Eagle Investment Management, another prominent value house, holds 0.68% of its portfolio in Cummins, but has significantly reduced holdings by 46.97%, a major red flag. Mayors and Power Funds shows no change in recent activity. Across all 13F institutional filers, 9.6% are net buyers, meaning they are holding more than 50% of Cummins in their portfolios. That falls well below the 60% threshold typically associated with strong net bullish sentiment among institutions. Insider ownership stands at just 1.38%, which is quite low. Management has minimal skin in the game. More concerning, over the trailing 3 months, we see 0 insider buys and 6 insider sells. This director and officer selling without offsetting purchases is a contrarian signal. Insiders appear to be reducing exposure. Taken together, the smart money picture is cautionary. Major institutional holders are either reducing or holding steady, insider ownership is minimal, and insider transactions are one-sided on the sell side. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at a 32 times PE and a 149% premium to intrinsic value by DCF, which in our view is stretched relative to growth and peer comparables. On financial strength, the balance sheet is adequate with an Altman Z score in the safe zone, but leverage is non-trivial and requires ongoing cash generation. On profitability, the company generates respectable returns of 12% ROIC, but operating margins are compressing, and free cash flow margin is modest at 7%. On growth, historical 3- and 5-year growth of 6% and 13% respectively has decelerated sharply to 2.6% in the most recent quarter, a red flag. On smart money, major institutions are reducing positions, insider ownership is minimal, and insider trading is one-sided on the sell side. All cautionary signals. Most recent earnings in Q1 2025 showed an EPS beat but revenue growth disappointment, reinforcing the narrative that the company can manage near-term profitability but faces structural demand headwinds. In our view, the setup presents a cautious case. Premium valuation is not supported by accelerating growth, institutional conviction is waning, and management itself appears to be trimming exposure. One might argue the case for a turnaround if electrified powertrains capture market share faster than expected or if diesel demand stabilizes. But the current data does not support that thesis. We would want to see evidence of revenue reacceleration, stabilization of margins, and renewed insider buying before raising conviction on this position. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Cummins Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.